So, what is the real story with China's economy heading into 2026? Is its massive engine starting to sputter? Or is it actually being quietly retrofitted with a new, high-tech turbocharger? It's a huge question, and believe me, depending on who you ask, you get two completely different answers. Today, we're going to unpack both.
You know, the key is to know China to do better business. You can save a ton of time and money with expert insights on trade and investment. So, a big welcome to our channel, Trade with China. Today, we are going to put two major financial outlooks for 2026 right under the microscope to give you the clarity you need to navigate what's coming next. So what's it going to be? Are we looking at a carefully managed slowdown, a year of navigating some pretty serious economic headwinds, or are we on the verge of a brand new bull market? To figure this out, we're looking at forecasts from two absolute heavyweights, the global banking giant Morgan Stanley and one of China's top investment banks, CIT Securities. All right, here's our game plan for today. First, we'll tackle the big question on everyone's mind. Then we're going to dive into those macro headwinds that Morgan Stanley sees on the horizon, a concept they call low-flation. After that, we'll switch gears and look at the market tailwinds that CIT Securities is so optimistic about. And then we'll wrap it all up with what this means for you. So why the huge disconnect between these two outlooks? Well, think of it like taking a photograph. Some analysts are using a wide-angle lens, right? They're capturing the entire landscape, including all the challenges. But others, they're using a zoom lens, zeroing in on these really specific, high-growth pockets of opportunity. Both pictures are real, but they tell very, very different stories. And this quote from CIT Securities, it's the perfect example of that optimistic, zoomed-in view. They're not just seeing challenges, no, they're seeing a strategic counterattack, a new wave of technological and industrial revolution. I mean, this isn't your typical business jargon. This is a really bold statement about where they think the market is headed. But hold on, that's just one side of the coin. Now, let's switch to that wide-angle lens and take a look at Morgan Stanley's more cautious, big-picture view. Their whole analysis really hangs on one powerful and kind of tricky concept that they've termed low-flation. Okay, so what in the world is low-flation? Let me break it down. Imagine the economy is still making more stuff, more cars, more phones, you name it. That's real growth. But the prices for those cars and phones aren't going up. In fact, they might even be going down. That's deflationary pressure, and it puts a massive squeeze on a company's bottom line, even if they're selling more units than ever. And this is where the numbers get really telling. Morgan Stanley is forecasting a pretty solid 4.8% real GDP growth. That's the more stuff part. But look at the nominal GDP growth, which includes price changes. It's only 4.1%. Anytime that nominal number is lower than the real one, it's a flashing red light that, on average, prices are falling. That right there is low-flation in action. This chart really tells a tale of two different economies inside of one country. Just look at those yellow bars for net exports. They are the powerhouse, right? Consistently driving growth. But then, look over at the beige bars, which represent what people are spending at home. They're just not keeping up. It's kind of like a car with one engine firing on all cylinders and another one that's just sputtering along. So what's putting the brakes on the Chinese consumer? Well, Morgan Stanley points to three main things. First, you've got the ongoing issues in the real estate market, which just casts a long shadow over everything. Second, the job market is a bit soft, so people are, understandably, a little hesitant to spend. And finally, some of those government programs to get people to buy new things are starting to lose their initial impact. Okay, so that's the cautious, wide-angle view. But what if those big macro challenges are actually creating the perfect storm for a totally different kind of growth? That's exactly the argument from CIT Securities, and it's all built around their idea of a slow bull market. And this slide right here is where you see the two perspectives really split. While Morgan Stanley sees this macro challenge of deflation and weak demand, CIT Securities zooms in on the market opportunities being created by incredible tech innovation and really focused government support. CIT breaks down their optimism into what they call four key engines. First, they see a lot more capital from both outside and inside China flowing into the market. Second, this money's fueling some incredible innovation in cutting-edge tech. Third, reforms are making the market itself more efficient and trustworthy. And finally, Chinese consumers are shifting, demanding better, higher quality products. You put those four things together, and you get some serious upward momentum. And they're not just being hopeful here, they are confident. This quote says it all. They fully expect some bumps in the road, some short-term ups and downs, but they believe the fundamental trend for 2026 is a steady climb upwards. In their eyes, this slow bull is the real deal, and it's here to stay. All right, we've heard two really compelling, but let's be honest, pretty contradictory stories. So the big question is, what does this actually mean for you, your business, and your investments? Let's cut through the noise and get to some actionable insights. So here's what you need to keep on your radar. First, expect the Chinese currency, the Yuan, to get gradually stronger. Second, don't forget that China's manufacturing supply chain is incredibly resilient. That's not going away. Third, look for a very supportive policy environment from Beijing, something called dual easing, which basically means easier credit and more government spending. And last, be patient. The shift to a consumer-driven economy is going to be a marathon, not a sprint.
And let's put a hard number on that currency point. Morgan Stanley is forecasting the yuan to strengthen to 7.05 against the US dollar by the end of 2026. Now, if you're dealing with international contracts or managing currency risk, that is a number you absolutely want to pay attention to.
So where are those pockets of opportunity that CIT Securities is so excited about? Well, they're pointing to some key sectors. You've got the ones you'd expect, like AI and semiconductors, but also high-end manufacturing, and even some really futuristic stuff like humanoid robotics and this new low-altitude economy, which is all about drones and urban air mobility. This is where the action's going to be.
So let's just lay it all out, side by side. What's fascinating is that the headline GDP growth numbers are actually really close. The real difference is in the story, in the tone. Are you betting on a cautious, export-driven economy facing low-flation? Or are you betting on a tech-powered, optimistic, slow bull market? That's really the choice you have to make. Look, this channel is all about bringing you practical knowledge to navigate business, investment, and culture in China. Your comments, they really encourage us and help us realize the value of what we're doing. So if you found this useful, please press like and subscribe now for more actionable insights and win-win solutions. You don't want to miss the possibility to understand and make money in trades with China. At the end of the day, China's economy is clearly shifting gears into something more complex, more nuanced. So the real question for 2026 isn't just whether you're positioned for the headwinds or the tailwinds, it's whether your strategy is smart enough and flexible enough to handle both at the same time. Thanks for joining us.